oil prices headed higher after Iranian nuclear negotiations were halted in Vienna, with no indication of when or whether they will resume. Oil prices had earlier dipped as President Vladimir Putin noted positive movement in talks with Ukraine. Our business analyst Bode Ososami has been monitoring crude oil markets and comments on the outlook as the Russian-Ukraine crisis continues to keep markets on edge.
Oil prices have been quite volatile, swinging over $130 and under $110 all within a week. But analysts obviously are very, very vigilant, knowing that we are seeing extremely unusual times. The most likely or base case is with Brent to stay at over $100 for a while, and that doesn't even factor in a complete cutoff in Russian oil and gas supplies to Europe. But it does see that disruptions will tend to get worse over the coming months, and some supply disruptions could actually continue for at least a year as we see more self-sanctioning biting on top of existing official sanctions. But due to the higher prices, demand will eventually come under pressure, and we'll see much more supply and prices will begin to come down. There is a best case scenario of disruptions lasting only a few months as tensions fade quickly. Analysts don't expect this to happen, ascribing only a very low probability to this possibility. Even if sanctions are lifted at some point in time, a large part of the self-sanctioning will remain in place for a while, and prices could continue to trade higher for longer compared to what it was before the pre-pandemic price. So you could still see prices way over $90 in this best case. The worst case is of course where we see full and extended Russian oil and gas supply disruption. This suggests we will see a full ban of exports of both Russian oil and gas for up to 2 years. And for this scenario, Brent would easily be over $150, peaking at about maybe $175 before we see demand begin to drop and having an impact on price. The possibility of even lower prices are dependent on certain developments, which many say are unlikely. One, we could see Saudi Arabia, the UAE, and Cuid increase their output by, say, 2 to 2.5 million barrels per day in about a month, which could flood supply. We know currently the leaders of the Saudi Arabia and the UAE are not taking President Biden's phone calls, so many say this is not likely to happen. The other thing, of course, is a quick revival of the joint comprehensive plan of action between Iran and the world powers, including the US. We could unlock about 60 million barrels of Iranian floating storage relatively quickly and add 1 million barrels per day of supply over the next 6 to 12 months. Again, it's not quite clear whether this is happening or it could happen in the near term, but clearly this is something that is being watched. The other thing, of course, that could bring down prices is if US crude production picks up remarkably. From what we've seen, production is still below pre-COVID levels, with rig counts still way behind expectations. But current prices would easily be encouraged would encourage small operators to expand their production, and of course there's also pressure on the majors to produce more. So in short, apart from a miraculous de-escalation potentially involving a ceasefire agreement with a rapid correction bringing prices more in line with fundamentals, it's unlikely that we are going to see that downward plunge or crude coming, say, back to under $80. But for crude oil, the dynamics are, like I said, highly unpredictable, very volatile, and analysts remain very vigilant and are watching the headlines closely.